Guys, I've got big news. Major breakup in the world of finance. Cathie Wood and Michael Burry have officially broken up. Michael Burry has officially exited his entire Zoom video investment. I think somebody saw Cathie Wood on the street crying. She is asking for help from her friends. And Michael Burry is just moving on like a very mean person.
She is asking for donations to buy more Tesla shares.
No, she's selling her Tesla shares.
Oh, she's selling?
Yeah, she's selling. She's a net seller of Tesla, isn't she?
Maybe
yeah, she's a net
buying
seller.
NVIDIA now.
Is she buying NVIDIA?
Next hot thing.
Of course she is.
Buying Facebook. Oh, God. Okay, guys. Paul is going to explain Michael Burry's big bet against the market. It is going to sound complicated, but options are something that you need to immerse yourself in. You're not going to watch this video one time and come away saying, hey, I get it. You're probably going to be saying, oh my gosh, this is so complicated. Watch this a couple of times, and I promise you that you will get it.
I saw something the other day that made no sense to me. It popped up. Michael Burry has a big short position in the market, 93% of his portfolio. I was like, well, that doesn't make sense. 93% of his portfolio. And then I started to look into it. I'm like, yeah, it's not 93% of his portfolio. Now, if you take the full value of all the things in his portfolio, yes, it's 93%. But the way he shorted the market. Now, you might be asking, what's shorting the market? Very great question. You're betting that the market's going to fall. You're not betting it's going to go up. You're betting it's going to fall, right? That's done in many ways. The way he did it was right here. So let me show you how he did it. The latest trade, no options. Ready? He bought puts. So what's buying a put mean? Well, in very simple form, here's what it is. The current SPY and QQQ. SPY is at 450 essentially, and QQQ is at 370, give or take. He might go somewhere in the future, like December 2025. He might say, listen, I think QQQ is going to go $200 a share. For every dollar that it goes below $200 a share on 2025, he makes $1. Now, the reason it's an option is he has to buy this option. So let's say maybe he pays $5 for this. So he pays $5 a share. He has 2 million shares. And guys, I don't know how much he paid. That's $10 million he paid. However, if it's 2 million shares, the value that's perceived in the market is 2 million times $370, which is 740 million bucks. So he's made a $740 million bet, but only spent $10 million of his money. Now, the way this works is basically either home run city or he's going to lose all that money. Now, let's say that QQQ goes to 150 on December 2025. He now makes $50 because what he can do is he can force somebody to buy these shares back from him at $200, and he only pays he can force somebody to pay $200 for these from him, but the market price is only 150. He makes $50. He invested 5, he makes 50. He 10x his money. Okay? However, what I do, because I short the same way, but what you're hoping for is what's called volatility. You can still make money on this even if the stock never goes below 200. Let's say in the next, we had a big run up this year, right? Mm-hmm. Huge run up in QQQ. Let's say suddenly in the next month, QQQ falls to 300. It's still above 200, but now the price for this $200 option has jumped from $5 since it happened so quick to maybe $10. Very quickly, a lot of volatility, boom, he just doubled his money. That's the way in which you can make money shorting a company at very, very far outlier monies. By the way, I looked this up. The delta on this is about 0.05. That means that the market perceives the chance of this happening at about 5%. Keep in mind, back in October, this was at 250. I believe it was at 250 back in October. So it's not that far out of the realm of possibility. So what Michael Burry is doing is he's trying to bet on very quick swings in the market. He's sitting there saying, listen, if this thing falls really fast, by the way, I don't know if it's going to be $10. It might be 15. It depends on how fast it falls. There's a lot of factors involved in options. The math is complicated. But let's say it goes to 15. He triples his money very, very quickly. So he's making this bet. But guys, if he holds this all the way through December 2025 and the stock stays above 200 the entire time and he never exits it, he loses $10 million. That's the key. So he's not really making a $1.2 billion bet. He's making a $10 million bet that involves 2 million shares at $370 a share, which is $740 million, plus whatever he has in SPY. Please re-listen to that because it can be complicated. And if you don't get it, don't worry. Options were hard for me when I first started, and I only started 3 years ago, and I was a pretty smart guy. I was like, wait a second, I don't get this.
It's counterintuitive to start with.
It is counterintuitive because you think to yourself, wait a second, you're paying somebody, but then you're receiving the shares, but you're not receiving the shares. I can force somebody to buy it.
Once you figure it out, you got it.
Once you figure it out, you do get it. But this is a way of betting against the company with limited loss potential. But you're also limiting your gain. And by the way, let's say the stock fall. Let's say this thing falls in half tomorrow to 185. This thing goes from $5 to $50 or something like that. $35, whatever it is. The bottom line is, if you don't exit it, you can. And if you stay with it, and let's say it ends up at, so let's say it goes to $50 here. You 10x your money. But let's say you keep it, and on December 2025, it ends at 195. You only break even. You paid $5. It's worth $5. You broke even. So with options, it's all about volatility, quick moves. He's betting on a quick move down in the market, which by the way, I don't blame him for. There's been a lot of irrational market going up. Just look at NVIDIA. Yesterday, NVIDIA was at 403 a share. Today, it hit 450, and now it's at 442 or something. What's it at?
QQQ is up 39% this year. Year to date.
39% year to date.
What do you want to know about NVIDIA?
What's it at right now? 444.
445. Yeah.
I mean, come on.
It's up 210% year to date.
You know, I've seen a lot of people criticize Michael Burry, saying he's been calling for a crash for years. I'm like, okay, well, guess what? This has really blown the minds of a lot of value investors going, this market has been completely irrational. And people will sit there and say, you know, it's funny to me when I hear people say, well, there's no reason it'll go down. Like, but you don't need a reason for it to go up. You're fine accepting it just going up for no reason whatsoever. You can make up things like, GDP is better and unemployment. It's like, yeah, but that's not going to stay that way forever.
It goes both ways.
It goes both ways. Yeah. Here's what I believe. I believe when the markets are irrationally high like they are today, I believe the stock market's 80% or more overvalued. I believe the John Hussman idea, which is the stock market is a room filled with gasoline and there's a fire in the corner. We don't know which spark will cause the explosion, but there'll be a spark that causes the explosion. It could be something that we don't even see today. Remember, interest rates were supposed to be the thing. Back in March of last year, interest rates were 0. Now they're 5.25 to 5.5. Markets are up from back then, pretty much even. Makes no sense. Low interest rates were the justification for this high market value, saying, well, I'm either going to get 0% or I can get something from the market. So people were just plowing into stocks. And at first, stocks went down. Now, stocks are back up again, baby. Mm-hmm. We were at 4,500 last year when interest rates were 0. Now we're at 4,450. Oh, wow. NASDAQ's down almost 1%. Mm-hmm. So, guys, we can look at all of Michael Burry's other investments to show you guys. He has 31 stocks in his portfolio right now. The other 7% is not from this. 7% of the total $1.3 billion of all his holdings, sure, but his actual equity is $118 million. And I don't know how big we don't know what strike prices he had for those options, so we don't really know what price he paid. He could have very short-term, let's pull up the example. Like, Mo, why don't you pull up Webull so we can look up, they could be as little as $1 each for each share that he shorts with the puts. It depends on what time frame he's looking at. December 2025 was selling for about $4.80 per share this morning for that December 2025 $200 strike price. But I don't know what strike price he has either.
So what do you want me to look for?
Let's look up like this December at $200.
This December?
Yeah, December 2023.
Let's go.
15th. Go to the 15th.
Let's go here. And for what price?
200. Put. 24 cents. Yep. So if he made this bet, 2 million shares are costing him what? 1% is 20,000, 24 cents each. So $500,000. He has a $118 million portfolio. It could be very little equity involved for him. He's just sitting there saying, listen, if I put 500,000 in and the QQQ falls by 30, 40% for the rest of the year, he might 10x his money very quickly. In fact, that actually sounds like a pretty good bet. Maybe to do that. I'm not telling you to do that, but I'm just saying this is how you can short the markets using options. And for him, it could be a hedge too. Yeah. He could be like, listen, I got a lot of equities out there. If the stocks fall hard, I'm going to lose a lot of money in my equities. So I want to keep that up. I want to keep that value up. I'm going to hedge by doing this because if stocks fall really hard, the most overpriced companies will fall the hardest, which is likely in QQQ. And if my stocks are down 20%, but I get a 10x on some 1% portfolio, he's only down 10%.
Right.
and that would be happy for him. That's something that we're going to do and when Mo and I get fully invested, when we see stocks getting irrationally high, we're going to probably start doing more hedging, which is buy puts and things like this. That way, you don't have any issue of like, you can buy really cheap insurance because the faster and faster stocks go up, the less and less likely people think these events are going to happen, which makes the insurance even cheaper. So to draw the analogy that Warren Buffett says, it's like the longer time frame you've gone without a fire, people think there's less likely to have a fire, which is actually not true. It's the same chance at all times. So they value that insurance policy very, very cheap. So you can really buy good insurance for very cheap. That's what buying these puts is buying insurance. Or you could just very well say, this is a stupid market. I'm willing to go out to December 2025 at $200 strike price, and I'm going to pay $5 a share. And if it hits, it's a big chunk of he might make really big money. It could be, by the way, that's how he made money in the Big Short.
The Big Short, yeah. He
bought insurance. He bought cheap insurance because he said, hey, listen, he sold the insurance essentially. I don't remember how it works, but does he buy the insurance or he sell it? He bought swaps. So he bought really cheap swaps. And then when the shit happened, shit hit the fan, those swap prices skyrocketed. He's able to sell it back to somebody else for a much higher price. There you go.
You need Margot Robbie to explain this to you again.
I do need Margot Robbie. So guys, this video was complicated. I get it. Watch it over and over. I just recommend you do one thing. Subscribe to the channel and make sure you put notifications on. You'll learn a lot. And the more and more you watch our videos, you'll learn more about options because we're very active with options. It's a great way to hedge. It's a great way to make bets and be paid to get stocks at the price you want them for. It allows you to be more patient. And that's what we're trying to teach all investors. Thank you very much for your time.